Awesome. Thanks everybody for tuning in. I think we've had a lot of really great conversation backstage, so there's a lot of room to have in this chat, and should be pretty exciting. I would love to just kick this off in a pretty straightforward way, go down the line, maybe make a quick introduction, and since we're talking about getting investments, your personal view on where the industry sits. I think we could kind of break it into both AI and blockchain and maybe how they overlap, but just kind of where your heads are at and what you're looking at present would be a very easy way to start this off. So let me just toss it to you.
Cool. Hi. Hello, everyone. My name is Joshua Rivera. I'm one of the partners and the general counsel at Blockchain Capital. Blockchain Capital, venture firm. This is the venture panel. This is the venture panel, right? Yeah, right yes. Place. We've been investing specifically and exclusively in crypto for almost 11 years. I've been with Blockchain Capital for over 6. We are, crypto very exclusively, though we do explore kind of the intersection of crypto and AI. We've invested in almost 200 portfolio companies or projects in the space. That's across 7 funds, and we manage about $2.3 billion in assets. Kind of where is the industry? I think we are in a really exciting time in the industry. We went through a lot of pain end of 2022 after a lot of centralized entities were doing really, really unreasonably risky things with other people's money. Most notably FTX, but also Celsius and BlockFi, and then the Three Arrows kids, and there was some DeFi shrapnel in there as well. But I think we've, as an industry, we've moved past that and recovered really well. Just on the building and tech side, we're still kind of enduring the consequences of that on the policy front. But I think post-election, whichever way it goes, we're going to have a lot more certainty, and there are things that are happening that will really accelerate the industry, I think, in the next kind of 12 to 18 months. So we're really excited about that. We are looking at the intersection, like I said, of AI and crypto. We led WorldCoin's C round. WorldCoin is not AI specifically, but it's like the other side of the coin from AI, right? Like the purpose of AI and machine learning is to accelerate the production of content to enable people to multiply their work. And then on the flip side, crypto is really, the intent is to identify discrete transactions or discrete instances of things. And so we think that they go hand in hand, or at least they counterbalance each other. And so that's how we see kind of crypto playing in the AI world, and then AI can be really helpful for ameliorating some of the more difficult, we talked about this backstage, some of the more difficult kind of technical implementations of crypto, at least the user experience. And so we're very interested in that right now as well. So yeah, excited to dive into any and all of that.
Thank you. Let me pass it over to Ed.
Hey everyone, my name's Ed Roman, and I'm one of the 2 managing partners and co-founders of AIxVC. AIxVC is an early stage Web3 focused venture capital firm. I've been an investor for probably about 15 years now. Prior to that, I was CEO of 3 startups and had a couple of exits out of that. I've been kind of an AI practitioner for a lot of my career, so I studied AI at Cornell University. I also ran a video game studio that used AI to use machine learning to understand the Nintendo Wii motion controller, to understand those motions and to quantize those into motions for a game. I've also taken classes in TensorFlow and Keras. So I'm kind of at the intersection of being a developer and an AI practitioner, but also an investor. I lead our AI practice at AIxVC, and it's again mostly Web3 AI focused. We used to do a lot of Web2 AI. So we backed a bunch of unicorns in the early days, like Weights and Biases. We seeded Observe.ai, which is a unicorn, Jasper.ai, which is another unicorn. But we really believe in Web3 AI. We think Web3 AI is really what's interesting. that's what I was hoping to talk to you about today, is that we think that the opportunities and where the market is headed right now, crypto AI is pretty much dominating the conversation right now. If you look at the historical public tokens for crypto AI in the last 12 months, I think there was about a 324% average appreciation for crypto AI public token. And that trounces all the other categories like DeFi, infrastructure, obviously NFTs, stuff like that, right? So it's just the most value accretive asset class right now in crypto. And I think for now, the reason for that is very mimetic, right? Because, in Web2 AI, with NVIDIA stock doing so well, all the crypto AI tokens have kind of followed suit because of hype and investor speculation. But I actually think there's a real long-term value that's being built in crypto AI, and I think it really stems from the GPU DPINs that underpin everything, because they're actually providing new unit economics to customers. With underutilized compute cycles, you can actually tap into cheaper AI inference and potentially training as well. And by doing fancy things like model sharding across a decentralized network, you can also have an additional level of savings by allowing large language models to be computable on smaller video cards, like consumer-grade video cards. So there's this whole crypto AI stack that sits on top of these DPINs, and that's like the category that I'm interested in right now. Like the AI inference layers, the AI prompt routing layers, the model serving frameworks like ZeroG.ai, which we let around into their seed, and also the AI agent frameworks that sit on top of all that, like Theoric, which we let around into. So this whole stack is evolving right now, and there's different layers to the stack, and the stack will bleed into each other in the different layers. But at the end of the day, it's going to create brand new economics for customers in both Web3 and Web2. And we think the interesting AI market is actually Web2, being served by Web3 startups that are creating those new economics for those Web2 customers. So that's kind of our thesis at Hack VC, and we've been very heavily deploying into that. I think about half of our last fund was just crypto AI. So that's us.
Awesome. Very cool, Ed. Hi, everyone. My name is Steven Wilinger. So I'm a general partner at the Blockchain Builders Fund. Unlike these two funds, you might not have heard of it. We are a Fund 1. We invest in early stage blockchain startups, mostly out of the Stanford ecosystem. I and my partners also help run some institutions on campus. We help run the Stanford Blockchain Accelerator, as well as an event series or a conference called BAS, Blockchain Application Summit Stanford. Teach a course on blockchain entrepreneurship here at Stanford as well. We are also, surprise, surprise, heavily investing in the confluence of crypto, blockchain, Web3, what have you, and AI. Yeah, I think these two gentlemen have covered a lot of the interesting things. I think my framing for this is like one, I don't know, every day I wake up and there's like some new interesting category in the space. I kind of put them in two categories. Like one, what are some blockchain-based technologies that can help drive the development of AI generally, both servicing Web 2 and Web 3. And so I think the DePIN category, both compute and storage, is an awesome one. A lot of the best clients for the blockchain startups in that space are Web 2 customers because they have a lot of money and have the current mind share and market share of AI. But then also separately, I think there's a totally wide open design space for what it means to combine decentralization and AI, splitting into both the, hey, how do we build, train AIs, specific models? How do we design specific use cases or enable specific use cases in a decentralized way? And then finally, hey, what fun applications that are kind of like at the confluence of speculation, memetics, and AI are there that will actually drive some retail adoption of both blockchain in AI in a way that isn't already being done in Web 2. And so we see a bunch of teams across all of those, and I'd be foolish to say that I won't uncover a new one tomorrow, and I certainly don't know what the ones that hit will be, but there's some that are very interesting and worth betting on. So I'll pause there so we can go into some deeper questions.
Yeah, I think you touched on a lot of very interesting things there. A lot of the conversation today has been around the infrastructure stack, and I think decentralizing the processing and a lot of the data. I'm just curious because crypto metas tend to turn over fairly quickly, almost week by week to some extent. And I'll start with you, Steven. I do feel the cycle kind of went for products built on OpenAI that really did not actually involve the Web3 investor community. for a good reason. They didn't own their fundamentals. But now would you say, have we come to a point where the infrastructure components are overly saturated in the investment landscape, or how are you seeing it? Like, are the great things already funded and we should be looking at the app layer? Just like kind of curious how you're seeing where it exists at present.
Yeah, certainly. So while there is a lot of funding going into the infrastructure space, and the word infrastructure is slippery in blockchain, I do not think we're even close to having seen all the problems that we're going to see, and therefore funding all the technologies that help unblock those problems, right? So in the current accelerator cohort, quite a few AI blockchain teams solving problems that they see that are coming down the road for decentralized and centralized partners. You're actually going to hear from one later today, Felix, around preserving confidentiality and like permissioned data access amongst AI agents, right? So I think we're not even close in that category, and it's literally unknowable. 5 years from now, the space will have changed so much that we still won't be done. So maybe within certain categories we're done. I won't name those, but yeah, not even close. But nonetheless, we're also seeing fun breakout like user applications, right? If anyone's been following the goat meme coin and what's the name of the Twitter handle?
Truth Terminal.
Yeah, exactly. There's fun stuff going on that's retail accessible, and that's definitely going to spawn a pumped up fund for similar use cases. So yeah, there's fun stuff going on both ends, I think.
Yeah, I completely agree with that, and I echo all of your comments, actually. I think that when you think about, is the infrastructure category too saturated in crypto, I think a lot of that sentiment comes from the past, because if you look at the history of crypto, there's always been solutions looking for problems. There's been infrastructure without the dApps that serve that infrastructure. Like a classic example of this is Filecoin, right? Filecoin launched in 2018. It's been 6 years. They still don't arguably have complete product market fit, right? There aren't that many customers looking for it. Filecoin, its all-time high, was worth over 100 billion FDV. It's now down to around 10 billion, right? Still a $10 billion protocol without a lot of product market fit. So, that's...
What about Arweave, though?
I'm sorry?
So what about Arweave, though?
Yeah, I mean, Arweave, I'd say, yeah, that's a better example. So, yeah, so I think that sentiment from the past is a lot of investors are maybe skeptical. There's too much infrastructure in crypto AI, but the counterpoint to that is that we have real demand in crypto AI. And I think a lot of that comes from these Web2 customers. If you look at, I think McKinsey estimated that the total addressable market for kind of AI in general is somewhere between 18 and $26 trillion annually. And that's projected over the next 10 years or so. Now, if you compare that to just to understand how big is that number, the entire GDP of the United Kingdom is only $3.1 trillion. So we're talking about a market that's like 6 times larger than the entire GDP of the United Kingdom, right? That's how much value there is in Web2 AI, basically, right? So if we think about Web3 infrastructure for AI serving those customers, I don't think there's too much infrastructure built out yet because there's such a massive market to serve.
Yeah, I don't have too much to add to that. I think we think you have said as much, there's a lot of noise, right? And so maybe there's not too much infrastructure, but I think it's unclear what the correct infrastructure, and I don't mean like one specific project right now, but I do think we are, there's a lot of like froth in the infrastructure market in our view. And it's difficult to understand kind of like which layers and which implementations within each layer is actually going to be the value capturing. And so I liken it to, I think you're right? There's so much over infrastructure in the history of crypto. And that was there's multiple L1s. They all, like at one point, like they were all going to do different things. And then, there was also the ICO boom where it was like, we're going to have a coin for a very specific thing that exists in the world today. And that was very silly. And so, yeah, I do think there's like PTSD around that. And so you got to balance it. But I do think it is extremely difficult to kind of map out where the infrastructure goes from here and like which infrastructure providers and implementations are actually going to be the value capturing ones.
Yep. And my thesis on all this is that because the crypto AI stack is being built upon these GPU DPINs, which are kind of like analogous to Filecoin, right? Except they're actually solving problems for customers by bringing them new economics in Web2, and it kind of works. All those layers of infrastructure that's built on top of those DPINs inherit the value proposition from the DPIN. So if you think about building an AI agent network, for example, one could argue, is that really necessary in crypto? Well, if you're running that thing on the DPINs, then you're bringing new economics to customers. Same thing for AI inference layers and then all the other layers in the stack, basically. So I think it all really comes down to that fundamental layer, like can we get new economics by reducing the amount of compute power needed to do AI inference and potentially training, which is another interesting area to explore as well.
Do you think, like, what do you guys think about the interplay between, you know, open source AI and closed source, and is, like, what, I'm anticipating you're going to be like, well, like, you know, like $100 trillion worth of demand, so it's not going to matter. Is that your position? Like, there's just going to be enough kind of out there to where we're going to be able to capture value on both sides, or do you think like open source is materially better than what's happening in the closed source space?
Yeah, I mean, if you look at the history of open source, right? If we go back 20 years ago from today, most of the top databases in the world were proprietary, right? You had Sybase, Oracle, Informix, right? Those are all the top market share databases. You fast forward to today, it's like Redis, it's Mongo, right? These are all open source databases. So open source has a history of eroding the market share of proprietary software, but also not completely replacing that market share. They typically coexist together. There's some challenges for open source AI, though. The biggest challenge is who is going to pay the bill for the open source practitioners to train their models? Because it's very, very expensive, right? You think about OpenAI, they spend 2/3 of their annual budget on GPUs to train their models, right? So how can an open source community get together and afford to do the training, right? Another question is who pays for the data? You have the New York Times and other content creators being litigious and potentially could sue anyone. And you as a general counsel, I'm sure you appreciate this, right? For open source creators who just abuse the data, right? So these are some of the challenges that are trying to be overcome right now. And there's actually some interesting ideas right now in the market for startups addressing this. So I think it remains to be seen how that plays out. But my thesis on this is that you can use Web3 Rails to more efficiently run proprietary models as well, which is kind of a contrarian take. Like there's nothing stopping us from taking a proprietary model, running it on chain on these efficient DPINs to bring new compute costs to Web2 customers. That is one possible.
Yeah, I think the efficiency there is correct. I completely agree. I think you still need to have the demand. Like who's gonna like foot the bill? And I think like there is I think we see this in some teams that are building, you know, crypto marketplaces for you know, open source AI training, where they just assume that because you can create a market on efficient rails, that there will be demand for that, and that's just not always the case.
I might jump on this on a different vector. I think there's going to be a lot of emergent AI use cases, like self-sovereign bots that trade and shill things on Twitter, which is a funny and like relevant example now. But there's other use cases that need to be like credibly self-sovereign in order to be interesting, and I don't know what those are. But one of the core building blocks of one of those is open source AI models hosted on permissionless, incredibly neutral infrastructure, right? So I think open source is like an absolute building block for that. Will it be as performant as closed source AI? It doesn't need to be, because much like as it has been in the blockchain space, like blockchains are way less performant than AWS, but there are use cases that require that like credible neutrality, indestructibility, permissionlessness, and so open source will definitely have a place because of those properties.
Yeah, I actually think the open source ethos and the crypto ethos are very hand in hand, and that's why we're seeing this marriage happen kind of right in front of our eyes. A question, Ed. You spoke about unit economics. We've talked about DPIN a lot, and I think there's probably going to be more DPIN conversations. But just want to get your take, because cryptocurrencies, at their foundational level, are very much about economic incentives. DPIN is really a alternative bootstrapping mechanism, right, in order to get these companies started up. Just curious as to your take on what you've seen so far. Like, are the economics working? Let's say we have somebody with a great idea here but doesn't necessarily know the token economics. How does that impact the investment flow, and do you work with founders? Just like we all say a lot of really great words about DeepIn, but like, where do we see it on actually functioning, especially from an economics perspective?
Sure, I can speak to this. So DeepIn, I think, is the category that, other than crypto AI, it's the category I'm most excited about in general in crypto. I think it has very strong product market fit. Like the bellwether example of this was Helium back in the day, right? Helium, for those of you who don't know, it's a decentralized network of kind of almost like these like little cell phone towers that you stand up in your home. You connect it to your cable internet, and you're not providing cell phone access, internet services to people around the world, so you're providing a kind of a grounds-up wireless network. So the reason why it's such a good fit for crypto is because if you were to ask a venture capitalist, hey, here's my idea for a startup, I'm going to stand up cell phone towers all over the country. No VC would ever fund that. Why? Because it's too expensive, right? Who's going to pay for standing up all those cell phone towers, right? It's a capital inefficient business. VCs hate that. They like software companies. They like capital efficient businesses. So, with tokens and DeepIn, you can actually almost like bootstrap your supply side of a marketplace. So think about Helium as a marketplace. On the supply side, you've got these little cell phone towers that anyone can run to provide internet, and they can earn income off that. The demand side are people with cell phones who want to subscribe and replace AT&T or Verizon by this new cell phone plan. That's the demand, right? Now, who is going to switch from AT&T or Verizon to this wacky new cell phone network unless they have cell phone towers in every possible geography? Because if you just have cell phone towers in Boston, that's not good enough, right? Because what if you travel to Florida, right? It's not good enough, right? So you have this critical mass problem. You need cell phone towers everywhere, right? So you can't earn any revenue until you have all the cell phone towers stood up. Well, what if we just use tokens to subsidize that supply side until we get to critical mass? Like, what if we used our token treasury to pay out tokens temporarily to those people who are early adopters, who are standing up those cell phone towers? So that way, they're getting paid not by actual customers, but they're getting paid by our token treasury. And then once we get to scale, we can then stop subsidizing those cell phone towers and replace them with actual paying cell phone customers. And that's what's actually happening right now with Helium. So this is the beauty of, I think, that applies to crypto and Web3, is that you can use these incentives to create new kinds of businesses that you could not create in Web2 because no VC would ever fund it.
Quick question for you on that one. How do you think about DeepIn networks that are like CapEx heavy versus CapEx light? So for GPU marketplace, I'm like bearing the lead a little bit, but I feel like GPUs are very much more of a marketplace than like a CapEx heavy DeepIn infrastructure place, because people are buying GPUs and hoping to commercialize them kind of regardless. Whereas Helium, huge amount of CapEx. I'm curious how you think about the two.
Yeah, well, with Helium, they started off by manufacturing their own cell phone towers, but then they kind of outsourced that to partners to make it more capital efficient over time. So Helium right now is actually pretty capital efficient. Like the individual has to pay for their hardware. It's manufactured by a partner. So the protocol itself is pretty efficient. With GPUs, I think where things are going, and like we're both investors in AIxWeb3, so we can talk about this. So like AIxWeb3 is an example of a GPU DeepIn where they're actually tokenizing the GPUs. So you can actually imagine having a financial asset class that represents a GPU, where you, as an individual investor, can make income off of a GPU. You can actually be part of this like kind of AI revolution by owning a GPU in a data center somewhere, or a fraction of that. And then as that gets used for inference, you're actually getting paid a yield on that. So by tokenizing these physical real-world assets, you can turn something that was not capital efficient into something that's very capital efficient, because now you're just dealing with tokens that represent those GPUs.
Yeah, I would argue you could take that yield then and move it into something like Athena, which is essentially a tokenized hedge play, and end up stacking your capital, which is another great use for probably an LLM financial manager or things to this degree. So curious though, do you think the current DeepIn token economics is working out? Is there something that you would maybe advise to people that are looking, with a clean slate to develop their econ? Just wondering how you see what you've taken away from the existing big DeepIn projects like Helium.
Yeah, I mean, from our perspective, I think Helium is really interesting. It's the tokenomics are unproven yet. Like you have to get to the critical mass of where you don't have to subsidize, right? This is like venture subsidized marketing, right? Where you think of like it was like Trivia HQ, right? Where they're like paying out rewards to get like people on board, and that's great. when you're doing it, it has to be sticky enough over time that once you hit critical mass of users, that they're going to continue to want to use that product irrespective of the kind of the subsidiary rewards. And in that case, it becomes like, how valuable is this like token ecosystem to every individual user? Because they're not like, the faucet is not turned on anymore, so they need to like independently value the ecosystem and their participation in it to continue doing so. And so I think like Helium has a really great chance to get there. I just don't know if they've gotten there yet.
Yeah, and I'll just add to that and say that the area that we've seen teams fall down a little bit is not planning out their tokenomics to be thoughtful, because if you think about it, right, if you're subsidizing your supply side, like in Helium's case with tokens, right, you have to make sure that those tokens have value, and if those tokens for someday get devalued for any reason, it might demotivate your supply side of your marketplace, right? So being thoughtful about what are like the sources and sinks in your tokenomics to make sure that there's drains in the sink, as well as a faucet at the top, that we have a balanced economy. That's really important to make sure that there's not too much inflation on an annual basis. You can even introduce techniques like staking and offering additional rewards so that people don't sell their tokens. And just painting that vision, I think it's really important for the CEO to get the community excited that this thing is going to work and it's going to become valuable in the long run. So having a charismatic founder, I think, is something that we index very heavily into at HackVC, because by being that compelling orator and telling that vision, investors will generally assign a reasonable valuation to your tokens before you're fully at product market fit, and that becomes a very valuable war chest for you to subsidize your supply side.
I'd love to jump on that. I think there's like different levels of ambition and different paths to success. Like Helium requires a ridiculous network size. So it requires all the things you just described. Charismatic founder, a lot of people believing in the vision, a token bid up and sustained at a high price in order to continue growth. I think we maybe lose sight in the Web3 space that you can often build businesses piecemeal by winning product market fit in smaller markets, and you can often have a product that like generates revenue and traction for specific use cases. Let's just say like providing like wireless in San Jose, even though we're back at Helium, that could generate revenue, and you might not have needed to have Florida yet if you could find a use case for the network locally, and then that could bootstrap the interest, improve the economics, improve a lot of other parts about the business that could then be leveraged to lever up, right? And you might not have had to have sustained as much dilution. So I do think for deep in entrepreneurs, there are different paths to market besides like, solving a global scale problem. Instead, you can create proof points that are more local with a subset of customers and that can pave the way for a larger success. It doesn't have to be all or nothing.
And just kind of talking about the founders and everything, would love to get your opinions on this, just more to set expectations for anyone in the audience that wants to launch one of these products. When you do place an investment, like what exactly is your philosophy around the founder versus the technology? I know a lot of this is very dry, mathematical tech, but at the same time, crypto is a very social space, very emphatic on Twitter presence. And realistically, like marketing hasn't quite worked very well, right? So just kind of looking for, this is like more advice for younger founders, maybe people that are stepping into the game, but like what are the expectations around a founder being bombastic, or like do they have to be vocal? Do they have to be outgoing and at every single conference? Like what is really the sort of edge that you see in balancing this relationship?
Yeah, well, I think Ed made a really good point that you want charismatic founders often for certain types of projects, particularly projects where a community is going to be going to need to get excited about the value prop. In our view, it's not like every founder has to be a charismatic one, but being apart from finding product market fit, being a really excellent founder is like the most important thing, right? When we look at a project, the space changes. To your question, I don't know, 20 minutes ago, right? The space changes so quickly, right? The metas in the space change so quickly that it is really important to be able to understand the ethos of the space and kind of the history of the space,
and all the new occurrences in both crypto and AI to be as adaptable as possible, right? Because we have changed our own kind of investing philosophy over the course of the 11 years that we've been doing this many, many times, because this space is still very young and burgeoning. And so that means it's going to go through lots of changes. Some things that we thought were going to work 5 years ago ended up not working. Some things that we thought were going to work 5 years ago do work now, but 5 years ago was way too early. And so like now there's like a different, there's a different iteration of that. And so I think like charisma is important, but adaptability and understanding kind of the broad strokes of the field that you play in are really, really important.
Yeah, absolutely. I think you can, so we work with a lot of very early stage, highly technical teams. They are not always going to be crypto influencers. They are not always going to be, they're not best used sometimes on stage at every crypto event, which there's literally one every week. It's exhausting and you can't build anything if that's your job. You can build teams. You can bring that person on, right? Us and Hack have one, like Zero Gravity has an awesome founder. He's very product minded, but he has infinite energy and is on stage all the time, and he's also very charismatic. And I think if you look under the hood of a lot of great crypto projects, they saw this gap, the charismatic front person gap. There's also strong community management and marketing teams underneath the hood. Like you can build this capability. And so, as an investor, I don't always see that as a yes or a no. It's more of like, what do we need to add on here to add that element if it's not present?
Yeah, that's the right way to think about it. So, I think the ideal scenario for a VC would be if the team is complete and has all these boxes checked, right? Because the charismatic founder is going to be able to attract the next wave of talent. He's also going to be able to get the community excited. He's going to be able to help raise the next round. So there's a lot of benefits to that. I think you do need that to a degree at some point in the trajectory of a protocol if you're going to maximize your success. We do have a recruiter on our team that helps startups source candidates like this in case they need like an evangelist for the community. And we'll do that in rare cases where we think a technical team is just absolutely excellent and they've created something that's really a breakthrough, and that they just need someone who has experience, maybe a previous founder of another protocol looking for their next thing, who wants to be their evangelist. Like that is a marriage that we've made in the past, and we continue to do that for startups.
Awesome. Let's talk tokens quickly because they are a big component of this ecosystem. I know I've been through many cycles. I've invested in many founders. A lot of times, people coming from a technical background are not quite as experienced in secondary markets, right? There's a bunch of Wall Street sharks out there that want to eat your token the second it launches. It's like an attack vector, every exchange, every pairing. So I'm just curious, right now VC coins are kind of getting the shit while the meme coins are a hit. And just how are you looking at tokens in general? Are you investing in tokens specifically these days? Are you leaning more towards equity? How do you advise people to look at launching, again, a liquid asset into a secondary market when your product hasn't hit product market fit? Like, if you've got the tech and you don't have the token econ, what would be some pointers that you could give to a founder?
Yeah, so we always do equity in tokens. This is because it gives founders flexibility to kind of choose what is going to accrue the most value. So multiple of our portfolio companies over time have been like, hey, we were going to do, like we were going to be an equity play, but we want to do a token now. And if we didn't like invest in the token, then we're like, well, that feels not great if like we gave you $10 million and we don't have access to the thing that you're going to pivot to accrue value. And then vice versa. We've seen people who are like, oh, I want to do a token, and then like a great example of this is TRM. This is not like known, but TRM was actually going to do more of like it's called TRM because it was going to be CRM, so it was more like customer resource management, and they were going to have their own kind of like ecosystems. This was way back in 2017. But like they ended up not doing that at all and not contemplating any kind of like digital asset, right? And so having the flexibility to be able to determine, to pivot in the context of a shifting industry, I think is really important. The question around VC tokens and why those are evil now, like I think that's valid. I think
look, like, there are plenty of really, really bad VCs, and hopefully, like, we are not one of those. But like, I can't just be like, no, VCs are good, like, it's fine, don't, you know, like, yeah, there's lots of VCs that I think make really unfortunate decisions. We try, in the context of all of our deals, to be extremely thoughtful around, like, what is an appropriate and fair and reasonable allocation of network ownership, right? So when you're investing in a token network, right, you're thinking about, like, what is the purpose of this network? What is the ownership and governance of this network? What should it look like, right? And we are all, I mean, at Blockchain Capital, like, I wake up in the morning excited to build decentralized ecosystems of value exchange, right? Like, I don't, like, we're not here to own 60% of a network, right? That's not what we're trying to build. And so if you're not kind of starting at the end of, like, what should this network look like when it's fully kind of realized and functional, and then working backwards to the investing time, right? You can make a lot of mistakes. So we were talking about this in the back too, like, we often have to come in at the A round and, like, fix a bunch of shit that happened in the seed round because nobody thought, like, about the unit economics or the distribution of the value of the network appropriately. And so I think it's really important before you start, like, chopping up, like, the network's gonna be this much to investors and this much to community, that you're being really thoughtful around what it should look like, and that you get a lot of thoughts, and that you work with a good VC. You know, it's not always easy to do, but yeah, that's what I would say.
Yeah, that's very well said. And just to add to that, you know, we've learned the hard way at HackVC that what a VC thinks in terms of their investment thesis may not always reflect what the market values. You kind of have to have empathy for the traders that are actually trading crypto every day. And the reason why meme coins have such high product market fit is because trading happens to be probably one of the highest, if not the highest, product market fit use case of crypto right now. Now there's other use cases too, like Helium. We just talked about other projects that are actually changing the world and solving business problems. But trading is another important part of crypto that you can't ignore. So when we look at a startup and we're thinking about investing in that startup, we analyze that startup from two different angles. The first angle is like the mid-curve take, which is basically, is this startup actually a good business? Like, you know, is it solving a problem? Is the founding team great? Blah, 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 right? Then there's the left curve analysis, which is, what will the public traders think about this? Are they gonna like this thing? Are they gonna get excited about the vision for this thing? And that's almost as important, or maybe even more important than the mid-curve take. And so I think having that empathy is important, and this also applies to Web 2. Like, if you look at, like, Web 2 stocks, there's plenty of Web 2 stocks that have crazy multiples and are overvalued, right? You know, look at NVIDIA, right? And, like, a lot of these situations are because the traders are valuing them that way because they believe in these things. Look at GameStop, right, for example, right? So look at Bed Bath & Beyond. So I think we can ignore that part of the market and say that's silly, right? Or we can embrace it and say, let's have empathy for it. Then let's have our investment thesis factor that in. So we think about both of those things, and, you know, when we think that meme coins will continue to be an interesting market going forward, as will venture class startups. We don't think they're going to replace venture class startups, because I still believe that venture class startups are solving important problems in the world and can be actual businesses at scale, which is not what meme coins are. So I think they'll coexist nicely in the future.
These guys speak truth. I seek to emulate you both in almost every way. The only two things I add to this topic are one, that the concept of a token is super hamstrung by regulation today. And I think if tokens, without necessarily being a security, could somehow have a greater stake in the economic output of a protocol in a more transparent, less, you know, workaroundy way, there would be a much more, like, rational design space for the mid-curve take. Also, you did retail dirty by calling them left curve, but the other thing I would add to this is, I don't know, meme coins versus VC coins are just like, it's just like such a different game that's being played, right? And we're kind of like in the middle of like a little bit of like a doldrums of retail adoption of crypto. We've got a bunch of green shoots on like where adoption will come from, be it in AI and agents, be it in payments. There's a lot of good stuff going on, right? But kind of like comparing the VC infrastructure coins to the meme coins in a period when we were building the infrastructure and the adoption should follow and the use of that block space or use of that infrastructure is yet to come is maybe a little bit unfair. And I think time will tell whether like eigenlayer's price is reasonable. Yeah, that's all I'll add there.
Yeah, I appreciate that. Didn't mean to push it to trading, but having been
Also,
through this,
not financial advice, not
Yes,
legal
exactly.
advice. It was
financial
medical
advice,
advice,
yeah.
though. So
but a token can be your best friend or your greatest enemy, right? Depending on how you treat this kind of thing. So a question for you. AI is really hot right now. It seems like we're going into another kind of bullish environment, very exciting. Having been through a couple cycles, can you give any recommendations on just how to survive the boom and the bust? Kind of what is like a consistent thing that takes people out of the game and what you've seen people that have actually been able to get past a few cycles, if you got any advice for our founders.
I've got a couple. So if you're a founder in the audience, it's not a bad thing to launch your token into a bad market or bear market. Because what will happen if you do that is if the market improves and becomes a better market, then the early investors in your public token, like the public retail traders, the KOLs, anyone who has a stake, they'll make some money on your token. And that's a good thing because then they become champions for you in the long run. The worst thing that can happen is you launch your token at the top of the bull market, the token crashes, and then all those early investors in your public token get washed out. Then that really hurts retail, it hurts sentiment against your protocol. So we think bear markets are good, actually, and if we think the market will get better in the future, it might not be a bad thing to launch now. We don't know how long the AI hype cycle will last. Like we are in kind of a bubble right now, I think, in crypto AI. Like we heard the statistics earlier, 324% average appreciation of a public AI token in the last 12 months. So I do think AI is here to stay, though, because like we talked about, the market is big, and I think Web2 AI will carry Web3 AI forward. I think the bubble could burst, though, if NVIDIA has a few quarters of missed earnings, and that will spill over, I think, to the crypto AI space. So, but if that happens, and if there's a bear market, not a bad thing for a founder. And so I would just plan your burn rate, raise more than you need to raise, be frugal, right? Don't get caught up on all this, right? And just be a cockroach and get through everything.
Can I just ask on that with the burn rate, what's like a nice buffer time to try to set expectations around?
Yeah, I mean, I think like if you can have 2 years of runway, like that's good. Like that will get you through multiple stages of a cycle, and will give you some kind of flexibility. I agree with almost everything you said. I think the one thing is like I wouldn't rush to launch a token because it's a bear market. Like you still want to. I think it's important to try to have a token that is functional, that means something, it like matters to the protocol, right? So one thing that irks us is that like just like you're like, okay, we're gonna have a token, okay, yeah, so like tell me about the token, and you're like, well, it's gonna be a token. We're like, okay, but like why are you gonna have a token? We're like, well, obviously we're gonna have a token. I'm like, okay, but like yes, like we invest in tokens and we're in crypto and crypto is a token thing, but like you need to be able to justify the existence of your token, at least for us. And maybe that's not like mimetic thinking enough, but I do think obviously for a meme token, you're just like, well, I'm gonna create a meme and I'm gonna sell a token, and that's great. So like I get that, but I do think like you want to have really thoughtful thoughts around what the token is, what it does, why people want to use it. Even if it is just like, look, there's this cultural zeitgeist right now around memes, and we're gonna like capture that.
yeah, so surviving bear markets. Yeah, I think like hopefully just like the mission and vision of what you can build here, right? You get to build things that are deployed globally on unstoppable state machines. Like you get to build totally different products than yet another SaaS product, right? So as an entrepreneur, you can build something that the world will touch. It could be the underpinnings of the global economy if you think big enough. There are just your ability to scale, should you build the right thing, is so large if you really believe in the space. So I think that should keep you going. That should be what you're thinking about That's why the space is inspirational. And in bear markets, you're just seeing people who were here for money leaving and then maybe coming back. And I don't think those people are necessarily technologists. They're super useful, and I agree we should build for them because trading is often the killer app. But they are not people who see the future often. So yeah, build because you believe those things are important.
Awesome. I'm going to add my 2 cents because Ed said my favorite word, which is you can easily survive by not overhiring and leaning on your community champions because you have token incentives and people love you and they'll do all sorts of great, wonderful things for you. So that's a really awesome talent pool to pull from. Anyway, that's our time. I hope you guys enjoyed it, and thank you so much for listening.